Gracias, Eva Villanueva. Está con nosotros Simon Harvey, Head of Forex Analysis and MONEX Europe and MONEX Canada. Thank you for having this time with us. Simon, good morning.
Good morning.
What do you think about United Kingdom and the situation of the pound in this moment that Kwarteng is flying to United Kingdom and Bank of England is in the time before to express if they continue or not?
Well, it's not fantastic, is it? I mean, imagine going away on a business trip only for your boss to call you back a day later on the potential that you may also be losing your job. I mean, it doesn't scream confidence, does it? And I think that's what's being expressed in financial markets over the past 2 weeks, in the sense that this plan was set out by the Chancellor of 45 billion in unfunded tax cuts wasn't necessarily the best option for markets going forward, mainly because it completely pushed against the Bank of England's objectives of getting inflation down, because the fiscal loosening was directly targeting households and their ability to spend at a time when the Bank of England was trying to bring demand down to lower inflation. So ultimately, I think the potential U-turn in fiscal policy will be seen as a good thing by markets, and we've already seen, the rumours play out and markets rally in anticipation of the announcement. The question now is, what's the extent of the U-turn? We're seeing rumours that around £24 billion worth of these tax cuts are going to be reversed, which is roughly around just over half of what the mini budget loosened policy by. The question is, how targeted is fiscal policy going to then be, and what does this mean for the Bank of England and financial markets going forward? And unfortunately, at the moment, it's all rumours. We don't really have too much information. But with the Bank of England set to leave the gilt market later today and leave markets up to their own devices, you'd expect the government, if they were going to make this announcement, they would either do it today or over the weekend before markets then open on Monday, without the reassurance of the Bank of England being within, holding their hand.
Could we see any movement of peace between Bank of England and government and United Kingdom government, or it will be necessary the rescission of Liz Truss in this moment?
I think that's what we need. I mean, if we're talking about how do we then start positioning ourselves for a large rally in the pound, start positioning ourselves for a big recovery in UK assets, I think we need to start seeing both the government and the Bank of England singing from the same hymn sheet. And that means fiscal policy is targeted to the point that we don't necessarily see an energy-induced recession, but it's not broad-based enough that it makes the Bank of England's challenge even harder. Therefore, you get this nice mix of higher interest rates, not to the level that we're expecting at the moment. You get fiscal policy that's working in hand with monetary policy, and all of a sudden, potentially, you start to see investor confidence coming back. Now, that's the big problem, because a lot of this government bond market in the UK is financed by external investors. And for foreign investors, it takes a long time for this institutional credibility and for this confidence to build, and only days for it to be completely destroyed. And that's the problem that these authorities now have. They need to rebuild this investor confidence, and the first step of doing it is by coordinating both fiscal and monetary policy going forward.
Could we see another countries in Europe like Italy, Spain or Germany in the same situation that United Kingdom in order to restructure their fiscal plan?
Yeah, I think this is the biggest lesson that we could learn here, is that the UK has tried going down this approach of protecting the economy from the energy shock and from kind of any recession as a whole. And the market doesn't like it, especially the way in which it went about its pro-growth policies. And for countries like Italy, for countries like Spain and Germany, especially with their new energy support, it's a warning shot. in the sense that markets will allow you to offset the impact to consumers and to businesses up to a certain level, after which it's only going to prove inflationary, and therefore it's going to make the central bank's job harder, and investors need more interest to start buying the more kind of returns to start buying these assets. And we're looking at the ECB, we're looking at the European Commission here and saying, you know, the IMF has even come out and said the UK did it wrong. It needs to be very targeted fiscal policy to the point that it actually goes hand in hand with the central bank's mandate here. Otherwise, you end up in the kind of the crisis that we've currently gone through in the UK. So you'd like to think, bearing in mind a very close nation has already experienced this just across the English Channel, that European leaders will take a lot of guidance from this and go, okay, we need to go back to the drawing board. We need to make our support measures a lot more targeted, and we need to allow the central bank to try and bring inflation down as best as they can.
One question, only one more question. Do you think that this is the beginning of the problems in debt crisis in whole Europe?
I think that there's definitely a risk of there being some sort of debt strain in Europe. I mean, we're looking at Italy right now, the coalition government's being formed. We're not really seeing too much progress in the sense of what their fiscal policies are going to be in next year's budget, which we expect to come in the next kind of month or so. And if they do go down that route of a big spending package, I think then we've got a very big problem on our hands in Europe. And because it will be of a fundamental nature, in the sense that investors don't want to finance this increasing deficit in Italy, that the ECB won't necessarily be able to use its transmission protection instruments to offset the kind of the strain in Italian bonds. And I think that's why you saw such a welcome response in markets by the news that maybe Germany is looking to back the joint debt issuance in order to offset the energy impact, because this will allow Italy to finance spending at a much lower interest rate. And therefore you won't really see too many strains in that market because some of the growth concerns are being offset and they're not issuing individually more debt. And I think that's the best measure to go down. The problem is it's highly politicized, so it may take too long to actually be to be authorized. But if we see Italy go at this on their own, I think we've definitely got a problem in Europe with regards to kind of market fragmentation like we had in the UK in bond markets, and then also kind of recession fears and investor confidence being impacted. And I think that's a big risk, especially when we look at currencies like Eurodollar going forward. It's not just the energy crisis, it's not just the recession that Europe's going through and is going to continue going through in winter months. It's also this big kind of risk that actually the bond market could explode and no one would really want to pick it up. So what we don't want is another Greek sovereign debt crisis on our hands. And I think the lessons need to be learned here from the UK in that fiscal policy needs to come in to offset the hit to households and businesses to some extent, but it needs to be orchestrated in a very careful manner.
Thank you very much for this analysis. Simon Harvey, Head of Forex Analysis at MONEX Europe and MONEX Canada. Thank you very much for having this time with us. Good day, good business, Simon.
Thank you for having me.